of monetary policy. Again, when I explained the fiscal policy, I said we have two different types of the fiscal policy. If you remember, the expansionary fiscal policy and the contractionary fiscal policy, and it depends on the state of the economy. So I said whenever the market is in a recession, the federal government starts to implement expansionary fiscal policy. On the other hand, whenever there is high inflation or the market is expanding, the federal government starts to implement contractionary fiscal policy. Now, let's apply the same concept or the same idea about the monetary policy. So here we have two different types of monetary policy. We have expansionary monetary policy and contractionary monetary policy. So the same as the fiscal policy. So as you remember, when I explained the fiscal policy, I said you have to understand, you have to answer three questions in each of these two policies. You have to answer when it's going to be implemented. You have to answer what are the tools used in each policy, and what are the outcomes or what are the expected outcomes from each of these policies. So in this video, I'm going to answer these three questions under each policy. So let's start with the expansionary monetary policy. When, again, from its name, you can guess, so expansionary monetary policy, so the federal bank starts to implement expansionary monetary policy when the market is in recession. So this means the market is bad again, so many people lost their jobs, the inflation maybe is high, the unemployment is high. So that's why the federal banks want to stimulate the economy by starting something we call it expansionary monetary policy. On the other hand, the contractionary policy is the federal bank implement the contractionary monetary policy whenever the inflation is high. That's why the federal bank want to contract the economy. That's why we call it contractionary monetary policy. Okay, more importantly, what are the tools in each monetary policy? In the previous video, I said that we have how many tools in the monetary policy? I said we have three tools. Let me repeat these tools again. The first tool is the minimum reserve requirement ratio, right? The second one is the federal fund and discount interest rate. And the last tool is the open market operations. Now, let's see how the federal bank will use each of these tools under the expansionary and the contractionary monetary policy. Okay, so first of all, I want to be clear about this. What is the goal of the expansionary monetary policy, or what is the expected outcome of the expansionary monetary policy? The expected outcome is what? Money supply. The federal bank want to increase. This is the goal from initiating or starting expansion monetary policy. So think about this. If I'm the federal bank, if I'm the chairman of the federal bank, and the market is bad, and my goal is to stimulate the economy by increasing the money supply, and I have three main tools in my hand. So how can I change? Just give me the direction of the change. How can I change each of these tools to increase the money supply in the economy? So let's start with the first one. So the first one is reserve ratio. Let's say if the reserve ratio now is 10%. I want to increase the money supply. Should I make it 15 or should I make it 5, for example, if it's currently 10%? So for example, let me explain this. So when I explained the reserve ratio, so I said if the deposit is 1,000 and if it's 10%, so the bank has to keep a reserve of 100, which is 10% out of 1,000, and the bank can make loans up to 900. Yes? Now, if I change the 10% to 20%, let's see what happened. With the same 1,000 deposit, now the bank has to keep 200 reserve, and the bank can lend only so this means by increasing the discount rate, by increasing the reserve ratio, the member banks in the economy has less amount of money to use it as loans. And this is not what we want. if we want to increase the money supply, we want to increase the money available for banks to lend it to customers. So that's why under expansionary monetary policy, one of the tools is what? Lower the reserve requirement ratio. So if it's 20, let's make it 15, 18, 10, but don't keep it as 20. So this is the first tool. On the other hand, as you can see, under contractionary monetary policy, we want to do the opposite. We want to contract the economy. We want to decrease the money supply. That's why the tool will be what? Will be increasing the reserve ratio. Okay, so this is the first tool. Okay, now let's see the next one. What about the discount rate? Expansionary monetary policy, I want to remind you, like, what is the discount rate? So this is discount rate. Let me remind you here. So this is the definition of discount rate. So this is the interest rate by member banks when they want to borrow banks from the federal bank. Okay, so stimulate the economy. So the federal bank should charge more or less on the interest rate whenever the federal bank wants to get some loans from the federal bank. So again, it depends on the goal. So if the goal is to increase the money supply, I want to make it easier for the people to take loans. So it makes sense to lower the discount rate, so that it's easier for the federal for the member banks to get loans from the federal bank, which is consequently, so the bank will lower the interest rate charged to the customer. On the other hand, if the goal is to start contraction of monetary policy, so it makes sense to increase the discount rate. So exactly the opposite. Okay, what about the last tool? And I said in the previous video, this is one of the most important tools in the monetary policy, which is what? Which is the open market operations, OMO. Open market operations can be buying or selling. So let's say this. Let me explain this. I'm going to explain the open market operations and think about the tool. So is it going to be buying or selling in the expansionary monetary policy? So let's say this is the federal bank and this is the member bank. So let's say this is Chase Bank. So the federal bank can either buy or okay. So if the federal bank buy T-bills, for example, buy T-bills from Chase Bank. So what does it mean? So who is paying the money? Think about this. The federal bank is buying T-bills from the Chase Bank. What does it mean? So this means the federal bank is giving money indirectly to the Chase Bank, right? If the federal bank is buying T-bills from Chase Bank, so this means the federal bank is increasing the money supply. On the other hand, if the bank wants to contract the economy, reduce the money supply, which means reduce the money available for the commercial banks to lend, so this means the federal bank asks the member banks to sell T-bills or T-notes or T-bonds to the federal bank. So if the member banks sell, it means the member banks has less money, less available money to lend the customer. So to make it short, so under expansion monetary policy, the federal bank has to buy securities. On the other hand, in the contraction of monetary policy, the federal bank sell. Okay, so just to summarize my points in this video, so I said we have expansion of monetary policy and contraction of monetary policy. What are the tools of the, first of all, when in a recession, when we start the contraction of fiscal policy, when inflation is high. The second question we want to answer is what are the tools in each monetary policy? Under expansion of monetary policy, here buy and reserve ratio, lower the ratio and lower the discount rate. What are the tools of the contractionary monetary policy? Sell securities and increase the ratio and increase the discount rate. The last question we want to answer is what is the potential outcome of expansion of monetary policy, the money supply will increase. What is the potential outcome of the contraction of monetary policy? The monetary policy will fall. And this is a summary of what I said here. Okay, this is what I have in this video. Thank you so much, and see you in the next video. Bye-bye.